So let's continue our discussion of risk, right? So we've talked about whether or not data is normally distributed. So if it's not, we know that the measurements of risk, standard deviation in particular, is not adequate to measure risk. So here's the question. Is it better to overestimate risk or underestimate risk? If you overestimate risk, that means you're going to have a tendency to reject investments you see them as being too risky for the return you would see. So you might reject some really good projects, but you would be much less likely to accept poor projects. And of course, if you underestimate risk, you might accept some investments that you think are going to give you enough return based on the risk that you measured, but that risk was not adequately measured. So a normal distribution, as I mentioned in a previous video, has a skew of 0 and a kurtosis of 0. Right? So it has uh, um, the measurement. If it's not 0, it implies that something is wrong with the curve, with the distribution. Positive skew for an asset for returns indicates standard deviation that might overestimate risk. So if we had to desire some form of skew, we would rather have skew that is positive rather than negative. As far as the fat curve, again, if it's greater than 0, standard deviation is going to underestimate risk. So any kurtosis implies underestimating risk. That is, we could be choosing assets that are um, more risky in reality than what we have been able to measure. So when we look at data, we have to understand, if we have these statistics, what does that mean for our decision making? Let's think about equity markets in general, right? So if we look at equity markets historically, this is the distribution that we have over time. Now, first question we have is, does this distribution look normally distributed? And the answer, of course, is no, it doesn't really look strictly as a normal distribution. So what does that mean for us? Again, we need to measure the skew. Is it positive or negative? What can it tell us about kurtosis? How can we ultimately measure then the risk of these assets? So if you look at some historic data, the average rate of returns on T-bills is 3.3, 5.96 for T-bonds, 12.17 for stocks. The risk premiums, T-bonds pay about 2.6 more than T-bills. Stocks pay about 8.87 more than T-bills. Standard deviation, you see that the indication here, at least, so the picture we're trying to point here is that um, riskier assets typically, historically, pay higher returns. Okay, that is our ultimate picture or window, if you will, to try to see what is actually going on with different asset classes. And if we were to gather data about small cap stocks, mid cap stocks, large cap stocks, they would fall into this range, and we would still find that the risk premiums, the standard deviations, this risk return relationship continues to be exhibited in real data. So let's look at some other ways of measuring risk. There's something referred to as value at risk. Now, typically, there is a number associated with VAR, a 1 or a 5. So, this is a measure of loss that's most frequently associated with extreme negative returns. So, VAR is the quantile of a distribution below which Q% of the possibilities fall. So a 5% VAR, this is the most common measured uh, VAR, is the return at the fifth percentile when returns are sorted from high to low. So again, this tells us what is the fifth percent. Think about percentiles. 0 is the lowest, right? 1 is the lowest. 100 is the highest. This is at the very bottom. So it's measuring negative returns. What is that number? Expected shortfall sometimes is called conditional tail expectation, looks at the expected loss in the worst case scenario. This is the left tail of the distribution. This is just a more conservative measure of downside risk than the VAR. It's even more conservative. So VAR takes the highest return from the worst cases. ES takes an average return of the worst cases. The lower partial standard deviation, again, think about this, think about what standard deviation measures, but this one measures only the negative deviations from that risk-free return. So this addresses the asymmetry in the returns kind of issue. There's actually something referred to as the Sortino ratio. This is a ratio of the average excess returns to divided by the lower partial standard deviation. Some other measures, average loss. This is the measure in terms of what losses occurred and then averages them. So it only looks at the negative side of risk. Probability of loss measures the probability of that. So we have lots of different ways that we can measure risk other than standard deviation. So let's look at some data and see what we see here. So here's our first company, Disney. This is relatively new data. So what we would find if you've been following Disney is that Disney's had the last couple of years have been pretty bad for Disney. And you can see that their average rate of return is negative 0.48%. Now, this is not annual. This is a monthly return. But again, if you multiply that by 12, right, so you get roughly a negative 5% or so loss over the average of these 4 years. Standard deviation is 10.49. Coefficient of variation, we talked about this in some other videos. It's negative because of the negative return. But let's look at some of these other statistics. The probability of loss is 56.25%. And the average loss of that probability is negative 7.68%. So it's kind of interesting, right? Kind of shows what? That we have some there's a 50% chance you're going to lose some money, and when you do, it's going to be around negative 7.8%, 7.8. VAR 5, that's that bottom point, negative 17.25%. We look at skew, we have positive skew. And what do you remember about skew? We go up here, let me go back another slide. Right? We want skew to be positive. So when we're looking at the risk here, we're looking at this distribution and say that whatever standard deviation is, that number is probably a little higher than what it is in reality. You can also see that kurtosis is very close to zero. When would we worry about this? I think we wouldn't really worry too much about kurtosis until it got up into the 2.0, 3.0 range. Then it starts to become a little bit more serious. Some other statistics that we did in this thing is something called serial correlation. What's the relationship between continuous returns? That is this month's return related to last month? And what we can see here is that um, definitely it's not positive, and it's saying that actually there's a negative relationship between consecutive returns. Now, it's not very high, it's very low, but it does show that there is some correlation. And the Sharpe ratio, again, Sharpe ratio negative of 0.151. Again, this is the return minus the risk-free rate divided by standard deviation. So we're showing some negatives for many of these. But let's look at Starbucks. So Starbucks has about a 1.26 monthly return, and multiplied by 12, we're probably around the 14% annual return. Has about a 7.6 standard deviation, less than Disney. The coefficient of variation, 6.03, kind of difficult to compare that to the negative of Disney. Um, but their probability of loss is only 39%. And if it did lose money, it's about a negative 6. What about the variance? The VAR 5, 12.54, 17.25. So essentially, we're saying that the risk levels, when we're talking about Starbucks, is much less than it is for Disney. Again, we have skew, but in this case, this skew is negative. So what this means is whatever this number is, it's probably less than what it is in reality. And again, a very low kurtosis. Everything else seems fine. Very low Sharpe ratio. So it's earning greater than the risk-free rate of return based on the risk level. So we can look at and make some comparisons to risk along the way. If you look over here, most of these probabilities of loss are in the 30 to 40% range. The average losses, and most of them in the 4 or 5% range. Again, depending on what your investment needs are, these numbers start to become more and more important to you. So let's look at correlation. Correlation is something that we've mentioned and talked about, but let's define it just a wee little bit better. Correlation is a joint probability statistic. It gives us a measure of how two assets seem to act alike. The correlation stems from the first statistic, which is called covariance. Covariance. Again, you can't see, there you go. So for a particular asset, a positive covariance implies that the data points, if you map them out on a grid, seem to be concentrated in quadrants 1 and 3. They're in these kinds of things, that things seem to act differently when they're there. Negative covariance points puts them in 2 and 3. So in this case, we see that we're here. This is 1 and 3. So we would say that this asset seems to have a positive covariance. Now, covariance is difficult. It's not difficult to measure, but you can't really make any interpretations. Correlation, you take the covariance and divide it by the product of the standard deviations of the asset. So if this line here, if that was the correlation, we would say that it is perfectly positive. That's essentially a 45-degree curve from horizontal. Perfectly negative would be in this other direction. What we find in reality is most correlations, I don't want to say most, all correlations are imperfect. So what we would find is things are all scattered around, and maybe we can draw a line in between that, right? So if we were to find the regression coefficient here, the slope of that line, we would be talking about an aspect or a particular aspect that could be correlation. So correlation standardizes covariance. It has to be between -1 and 1. And of course, we can rewrite covariance, right? Covariance is correlation times standard deviation of the two assets. There is another statistic, coefficient of determination, that tells us something about power. How much does one asset explain about the movement of another? And you square the correlation. So if we go to one of our assets here, this is the correlation matrix, a partial one. So if we look at the correlation between Disney and Harley Davidson, the correlation is 0.473. So 0.473 means it's what? It's a positive correlation, right? It's not -1, it's not 0, it's not 1, it's in between that range. And if you square that number, if you square 0.473, we end up with a number of 0.223. 22. So Disney, if you're interested in looking at Disney and Harley Davidson, we would say that those two assets, they explain about 22% of each other. So what would you like? You would like to have very high coefficients of determination, which means you want very high correlations. If we look here, this ACSTX, this is the common stock mutual fund, has a correlation of 0.755. So that means that Disney, or this common stock mutual fund, they explain about 57% of each other. So if you want to predict something, you need variables. So we need to know, are these variables strong or are they weak? Well, we would like to know how these assets, what is their correlation to some mutual funds, or excuse me, to some indexes. So let's look at that. So Disney, GSPC is the S&P 500. You see it's 0.752. So if we could forecast the stock market or give a prediction of the stock market, that information will tell us roughly 52% of what's going to happen to Disney. If we go over here, these numbers get pretty big. What about the German index? Again, they're a little bit lower. Still some big numbers, but lower. What about the Nikkei? Even lower. So what we would say is if we want to predict something in our domestic stock market, we definitely don't want to use the Nikkei exchange because it doesn't give us enough power in the prediction process. So again, lots of things going on here with calculating returns, understanding how risk works. In the following videos, we're going to try to incorporate this. How do we use this data to determine which portfolios we want to purchase? And of course, within those portfolios, we need to decide which stocks are the ones we want to buy. Look forward to seeing you soon.